Hey everybody, so today I want to talk to you about escrows, impounds, and prepaid expenses. Specific elements of your closing costs that are really sort of shrouded in jargon. It really created a lot of confusion around the closing process. And part of it's just the semantical usage of these terms. Different people use different terms to describe the same thing and it's confusing. And also the structure of how these things are paid and how they're collected can also be a little bit confusing. So first of all, just the semantics of it. Escrows or impounds are really synonyms. Escrows or impounds are synonyms for your lender collecting and paying on your behalf your county real estate taxes and your homeowner's insurance. Now this isn't the county taxes or insurance that's due at closing. This is collecting on a monthly basis from you. This is called escrowing or impounding an amount so that they will have enough to pay the renewals or the next payment date when it comes due. So for example, in the state of Washington, county taxes are due April 30th and October 31st. And you pay the first 6 months on April 30th, January through June 30th of that year. And the second 6 months is paid in October 31st. And if you're a lender and you've taken that responsibility, you're escrowing, you're impounding taxes and insurance. So every month, along with your regular mortgage payment, you're going to include 1/12 of your estimated real estate tax payment that's coming due and 1/12 of your estimated insurance renewal premium that comes due at the next renewal date. And there's two terms for that. One's called escrowing, one's called impounding, and those are really synonyms for one another. So hence some of the confusion. And sometimes you'll see the settlement company, which to add to the confusion, it's also called the escrow company. They really have nothing to do with the monthly collection and payment of your escrows. But the escrow company will refer to it one way, the lender will refer to it another way. So we're going to look at the different ways that these show up on their different documents. But just know right now that escrows and impounds really refer to the same thing. And what they refer to is the lender taking responsibility to make your insurance renewals that they come due every year and paying your real estate taxes as they come due every year. Now just understand sort of conceptually that if you wanted your neighbor to do this, let's say you talked to your neighbor and for some weird reason you wanted them to pay your taxes when they came due and pay your insurance. Maybe you don't trust yourself to save the money. You'd have to give your neighbor some money every month. To say, okay, every month I'm going to give you a little bit of money and you put it in my piggy bank so that you can pay this when it comes due. And it's not like then when that comes due and they pay that you can stop, right? Because now you have to start saving for the next one. And it's the same way with the lender. When they're taking responsibility, they're collecting from you every month. And they're doing so that they can always be collecting for the next payment that comes due and make sure they have enough. And we'll look at the escrow disclosure statement. Lenders are required to disclose how they've decided how much to collect from you up front and how much they're collecting from you monthly so that they're not over collecting. And we'll look at that. But just to understand right now, that's what the process is. Escrows and impounds are collections by the lender on a monthly basis that they put in then your escrow account or your impound account so that they can make those payments for you when they come due. Now prepaids are different. Now they also generally relate to homeowners insurance and real estate taxes, but prepaids relate to those items that have to be paid at the closing table. But those items aren't collected and then held by the lender to be paid on your behalf at a later date. They're collected at closing to be paid right away. Now the most obvious one of those is homeowners insurance. Whenever you finance a home, you are required to pay at least 1 year's homeowners insurance in advance. Okay, that's both Fannie Mae, Freddie Mac, both require that. So you go out and shop for insurance, you figure out who you're going to use for insurance, and you're required to pay a full year's premium in advance. And generally, that's going to be paid through the settlement company or the escrow company. They're going to collect a full year's premium from you at the closing table. That'll be included in your final number of cash that you need to bring to that table. But they're not going to give it to the lender. They're going to pay PEMCO or GEICO or whoever you happen to use for your insurance. So that's why it's called a prepaid. It's not an escrow. It's not an impound. It's a prepaid because you're paying that in advance to the insurance company. Taxes can also be the same way. Now, generally, in our state, you only pay taxes to the county at the closing table if the due date for that next county payment is close to the day that you're changing ownership of property. Because when you change ownership in property, of course, the seller is no longer concerned about paying the county property taxes because they no longer own that property. That's no longer their problem. They're not concerned about that, but the buyer or the lender, if the lender's taking responsibility for making those payments, may not have time to get everything set up, to get you in the system, to contact the county, to make that payment, to affect that transfer of ownership at the county level. And so all of that can take time to happen. And let's say that you're closing, in our state, let's say you're closing on April 15th and the county taxes due April 30th. Well, we're going to pay that April 30th payment through the escrow process. We're going to make sure that's paid and done so that the lender has time to get you in the system, to get you all set up, and they're not responsible to make an actual payment to the county until 6 months hence, in October in that year. And in that case, that payment to the county would also be called a prepaid. Now, what I want to show you next is where these things show up on the various statements. So I'm going to bring up now the different statements. Let's go ahead and start with the lender document. The lender document that contains all the final numbers is called the closing disclosure, or CD for short. You'll hear lenders talk about that. That's a highly regulated document. And that's one of the themes that you'll see here is lenders are much more regulated in terms of where we can put things and how we label things. Whereas escrow has a little more flexibility, so you'll see more variation there. And that does lead to some confusion, because not only will different escrow companies label them differently, put them in a different spot on the settlement statement, but they'll also call them, they'll also do that differently than the lender will. And so that's why you'll see some of that confusion. Now, it's not unlimited. You'll see, within a fairly narrow band of terminology and location that you can cover everything. But let's go ahead and take a look at that. So this is the closing disclosure. No doubt you've seen this. If you've borrowed money before, you've seen this statement. It's the closing disclosure. It's kind of the final accounting of all the numbers. What your interest rate is, what your loan amount is, what your monthly payment's going to be. But for our purpose today, we're really going to talk about the fees. You can see that it has to be precise, it has to be accurate, because it comes up with a final cash to close, and this has to match. This is what we balance to with the escrow company. We create this closing disclosure. The escrow company creates what they call the settlement statement, and we both are supposed to have exactly the same numbers in there, but they don't show up in the same place. But of course, the first ways you can tell if they have the same numbers or not is just look at this final number. Is the final cash to close to the penny the same? And it's gonna be. It has to be. We have to balance to the penny before we'll do that. So let's take a look at this. Right now, we're concerned on this closing disclosure with this section F and this section G. So what you see here is under prepaids, in this case, we closed this loan right now where we see property taxes. There are no prepaid property taxes on this loan. This is a real transaction. Of course, I've redacted all the personal information, identifying information on here, but this was a real transaction. We closed this at a time where we weren't close to the next county payment date. So under prepaids, you see 0 property taxes. But what you do see here under prepaids is the homeowner's insurance premium, and it's really small print here. But you see this $12.99, that's under homeowner's insurance premium 12 months, in this case to Progressive Homeowners Insurance Company. So this is a legitimate prepaid. This is not going to the lender. This is your full year premium in advance that we're paying to the insurance company. So you're prepaid in advance. But you'll also notice down here, look at the initial escrow payment at closing. Right here, and we see that, we're going to also fund 3 months worth of homeowners insurance. And so we're going to advance deposit with the lender 3 months worth of homeowners insurance. And the reason for that is the lenders are allowed to have a 2-month cushion. This escrow account that they collect is federally regulated, and they're only allowed to have a 2-month cushion. They cannot collect any more. That will never allow that impound account drop below that 2-month cushion. Now, it's not quite as straightforward as it might seem at first, because this is an aggregate cushion between everything that is being collected for in that escrow account. You don't have a separate escrow account for taxes and a separate escrow account for homeowners insurance. They're all in a single escrow account. And that's the cushion that is regulated by the federal government. So the lender will collect only so much as will never allow that to drop below a 2-month cushion. And basically the way that cushion works is, you start with a balance in that account, and then every month you're adding, in this case, you can see the monthly homeowners insurance is $108.25, and the monthly property taxes is $239.05. So it's about $347 or so per month that you're adding into that escrow account. And we'll look at a form in just a minute that shows that lenders are required to disclose to you that the federal government created to demonstrate how the amount that they're collecting doesn't violate that cushion rule. But that's what you call initial escrow payments at closing. These aren't extra costs, and that's the other thing to keep in mind. This is $1,041. It does show up as settlement cost on your closing disclosure. It shows up on your settlement statement from the escrow company as cost. But understand, this is just your homeowner's insurance and your real estate taxes, and you are funding those in advance. With the lender, you're putting those on deposit so that they can begin collecting and pay those as they come due. And by the way, the reason for that cushion, there's nothing really nefarious about it. It's, real estate taxes can go up, homeowners insurance can go up, things can change. And it's really bad if the lender has to go pay your county taxes and they don't have enough in the account to do that. Missed county taxes can create a lien against your property. You don't want that to happen. Missed insurance renewal premiums, if you don't have enough to pay the renewal premium, can put your property at risk, right? Now your property's, you can't pay the renewal premium, you're uninsured potentially, and that can create a real problem. So that's why they have those cushions that are allowed. But that money is always yours. Every bit of money in that escrow account is yours until it's paid out to the county or paid out to the insurance company. So whatever's on balance there, when you pay off that loan or when you end that relationship with that lender, that all is going to go back to you. So don't worry about that money. But this is kind of where it shows up. It shows up at section G, initial escrow payment at closing. So you see you got 3 months worth of homeowners insurance, and there's a reason why it's 3 months, and we can talk about that. There's a reason why it's 3 months worth of property taxes here. That again is a video for another day, but just see that that's where those numbers go. Now let's look and see where these numbers are. So we see that this prepaid homeowners insurance shows up here under prepaids. Under Section F, again, this is a highly regulated document with closing disclosure. Lender is required to put everything in very specific places, and so you'll see a lot of consistency here with lenders. You won't see quite so much consistency with escrow companies because they're not regulated to that level in terms of where they can place things, what they can call things. And so we'll see in this particular instance that the settlement company just called this miscellaneous. They put this at the bottom of the settlement statement. They called it miscellaneous. Now, it's still the right number. It's got the right label on it. It says it's going to the insurance company. It's under the heading miscellaneous, and then it does say homeowners insurance. But we'll see that that goes in a different place, and that's sometimes why it's hard for you to reconcile between these two numbers, especially when you're already kind of swimming in a lot of these details. The last thing I want to point out to you right now is this little thing called aggregate adjustment. What is this aggregate adjustment? 3 cents. We got this 3 cent aggregate adjustment here. And again, because this is a federally regulated account, it's very precisely regulated and very strictly patrolled. And so a lender is only allowed to collect so much as will not allow that cushion to drop below a 2-month cushion. And so what they have to do is they say, okay, I'm going to collect 3 months worth of homeowners insurance. That's generally right. 3 months worth of property taxes. And I'm going to put that in my beginning balance. And then I'm going to do a pro forma showing what that escrow account goes to for the next 12 months. So every month I'm putting another, what did we say? It was 239 plus 108, 330, 347 or so per month into this escrow account. And my account's growing. And then here comes April 30th and I have to pay a county tax payment. So my escrow account drops. And then here comes October 31st and I have to make the other half of the county tax payment and it drops to X. And then here comes the year anniversary when I have to pay that insurance renewal. And basically they take that projection, that pro forma, showing what the balances will be, and they can only collect so much up front as will allow them to have exactly a 2-month cushion. And so in this case, when they ran the pro forma, when they just took 3 months of insurance, 3 months of taxes, they were 3 cents over. At the lowest it dropped to was 3 cents over the cushion they're allowed. So they had to do this thing called an aggregate adjustment. And basically that's just a way of saying we're not going to quite collect this amount in total from you up front. So let's take a look now at the settlement statement. Let's take a look at how that shows these same numbers. So here is, again, this is the real settlement statement for this transaction. First of all, what I want to show you here is these same numbers. Here the escrow company, they call these impounds. So right now we're not talking about prepaids. Prepaids, we're talking about impounds or escrows. So they're calling it the same thing here. And basically you can see the identical numbers. And this is generally going to be exactly how it's presented. They're going to use exactly the same numbers in exactly the same way because the lender dictates these numbers. We're the ones that have to be accountable for our impound or reserve account. We tell the escrow company, here's how we want to present it. And so we're going to collect 3 months worth of real estate taxes, 3 months worth of homeowners insurance, and then we have that 3-cent aggregate adjustment. And so the total, and remember this number is $1,041.87. Now before we get to that, we'll go and look at the federal disclosure. That's why I want you to remember the $1,041.87 because we're going to go to the federal disclosure in just a minute and kind of show you how that pro forma works and what you'll see in your closing documents to confirm that the lender's only collecting so much as they're allowed to collect. But before they do, I want to show you, we talked about prepaids and sometimes lenders show them in different places. Well, in this case, here we have, like I told you before, miscellaneous charges. This is where this lender says this escrow company, instead of putting it under a prepaid or calling it prepaids, they're calling it miscellaneous charges. And you see it's the homeowner's insurance premium, 12 months, it's the same exact amount. It's just in a different place. But again, the proof is in the pudding. Here you see the $94,513.28. That's penny accurate. That's penny reconciled with the lender to the penny. We have the exact numbers on here. They're just located in different places. But that's obviously a shorthand way of confirming that, hey, we're ultimately dealing with the same numbers. Now, the last thing I want to show in this video is I want to show you how the federal disclosure works. And so let's take a look at that. Remember the $1,041.87? And that, again, is just the aggregate of the homeowner's insurance, 3 months worth of reserves here, the property tax, 3 months worth of reserves here, and the aggregate adjustment of 3 cents amounts to $1,041.87. So now let's go to the last document I want to look at in this video, and that's the federal disclosure that you're going to see. This is in your final loan documents. It's not going to be in your initial application documents. It's in your final loan documents that you're closing at the escrow table, and it's just called the initial account disclosure statement, initial escrow account disclosure statement. So this is, escrow / impounds. Again, this has nothing to do with the settlement company per se, who are also called escrow. This is your escrow account. And remember, first of all, that we talked about monthly, you're going to be paying $347.30 per month. And you see that every month. In this case, the first mortgage payment was due in December. And so basically they just say December, January, February, March. They show you're going to make your monthly payments here. And then over here, they're going to show your payments. So what amounts, these are amounts that are deposited into, those are amounts that are deposited into the escrow account. These are the amounts that come out of the escrow account. And so we see on April 1st of 2023, they're going to have to pay the first installment of the county taxes for April of 2023. And so then in October, which this happens to be around the time when this loan funded, and so the renewal date for this insurance policy is going to be a year from the closing date. You're going to have to pay the full year's renewal premium. Now at this point, we're using the same renewal cost as the premium that we just paid to buy insurance for the first year, that first prepaid amount, because that's the best estimate we have. But again, that's why we allow for a cushion here. That's why the federal government allows for a cushion there, because that could go up, as well as real estate taxes could go up. And so then you also see then the October payment. And here we are in the state of Washington, so this is the April half of the county taxes. This is the October half of the county taxes. And what you see over here is what happens to the loan balance, okay? And remember that 104,187. This is the initial deposit. And we saw this, we saw the initial deposit. Don't know how I actually created that red dot, but I kind of like it. So I'll have to figure that out at some point. But we saw here that on the settlement statement and on our closing disclosure, this was the amount of the initial deposit. We had 3 months worth of taxes, 3 months worth of homeowners insurance, And then we offset that by a 3-cent aggregate adjustment, and it amounted to 101.87 and 104.187. And then you can see every month what happens to the balance. Every month you add a new amount to the balance. And ultimately, what this proves to us is we've taken it through a full year, and we've seen that if we start with this initial balance, that our lowest balance at the year is $694.60, which happens after that second county property tax payment. And that is, here it says, cushion selected by the servicer. Well, every servicer is going to select a cushion of the max they're allowed times 2, which is this monthly amount times 2. So this loan is allowed to have a cushion of $347.30, which is your monthly tax and insurance portion of your mortgage payment, times 2. And we can see by collecting 104.187 up front, you have created exactly that amount of a $694 lowest balance throughout the whole year, happens on this payment after the 10/1/23 payment of your county tax payments. And what this demonstrates is this is within the law. This is how the lender is allowed to collect. And remember, if you were to refinance any time during the year, this money is all yours. If you refinance after this payment, you'd have $2,300 sitting in the escrow account, and that's all yours to keep. I hope that helps. Let me know if you have any questions. If you like this kind of information content, yes, please subscribe, like, share it with your friends, and please do in the comments, let me know what else you'd like to hear. Thanks so much.